The whole sell-off we've seen in Chinese tech, is this now a buying opportunity? Well, our next guest says, think again. Investors have had a long and profitable engagement with Chinese growth stocks. The recent correction could lure them back to buying the dip, but they are banking on the old, easier regulatory environment, returning an erroneous assumption in our view.
So? Come on, Ajay.
Absolutely.
We had to set it up for you perfectly.
Those are my words.
Exactly. I wanted to set it up for you.
Yes. Ajay Kapur, we should mention here as well, from Global EM Strategy Head for APAC at Bank of America.
Great to see you guys again. Yeah, look, I've been very bullish on Asia and its equities in general for over a year. I've been bullish on China for almost 4 years, but last December we downgraded from an overweight to a neutral. And my concerns were, hey, the credit cycle there is turning down. The regulatory environment is turning aggressive and unhelpful to equity holders. And I believe that that is going to continue because a lot of our clients feel, look, this is a buying opportunity. These stocks are down 30–40% from their peak
Cheap
levels.
for a reason, right?
Well, I don't think they're cheap at all.
Okay.
See, that's the key point. You know, on our valuation models, Chinese growth stocks are about 60–70% overvalued. And growth stocks around the world are generally quite overvalued, but the Chinese names really take the cake. And so what I'm telling clients is this regulatory, difficulties, these are not going to go away because I think there is a convergence between what the Communist Party is thinking and what the Chinese government is thinking. Because the recent July 6th note on overseas listings was jointly written by these two entities. And so to me, that's a very weighty statement. Normally, just the regulator would write this. But this is the general office of the Communist Party. And so I feel that for reasons like as you mentioned, anti-monopoly, pro-competition, pro-innovation, data security, national security, hey, we've got these great companies, let our own citizens be allowed to buy these. And also we don't want a fintech bubble. So I think these are not going to go away. And so my recommendation to our clients is, well, we have some great companies in these sectors, so e-commerce, EVs, gaming, internet, biotech, healthcare, in countries outside of China. So Australia, Japan, Korea, Taiwan, India, even ASEAN come to mind. The market cap of these names there is about 2 trillion. In China, it's about 4 trillion. So while big cap Chinese tech are not doing well, as we know, but if you look at the Chinext, it's up 20% year to date. So small cap, innovative tech companies are doing quite well.
There's still people that are a little bit more optimistic than you, Ajay. And I want to throw up a quote from Rob Sanderson from Loop Capital. He said, "We have trouble understanding how the nuclear scenario, which would alienate foreign capital and significantly impair China's investment worthiness, could possibly help the party deliver on its 5-year and longer-term agenda." They're saying it is a buying opportunity when it comes to Chinese tech. How do you respond to investors like that?
Well, as I said, I think people feel that just because stocks are down 30–40% from their peaks, that they're cheap. And so if these names were undervalued or fairly valued or moderately overvalued without the regulatory overhang, or you have an anticipation that it's going to go away, well, sure, it's a buying opportunity. But my point is, I thought they were expensive even 40% ago.
Yeah.
I still think they're pretty expensive. And surely, with all these new regulations that I don't think are going to go away, your return on capital assumptions, your total addressable market growth assumptions, your reinvestment rate assumptions, the amount that you can monetize assets, those assumptions, I think they all need to be pared down. And when you do that, when you're 60% overvalued, I think it's a bit tough to justify.
So, Ajay, what actually is driving this? Is it just purely the tech side of things and the regulators trying to coalesce the different bodies together? What's driving the regulation and the scrutiny?
Well, the factors that we sort of talked about, which is, whether it's the US or Europe or China, they don't want these powerful monopolies to dominate certain sectors. Because there's enough research out there that tells us that when you get massive monopolies in a few sectors, it is really bad for innovation by the other guys in that sector because they simply can't compete with you. And so the overall...
So it's not a grab for power?
Well, I think, given the political alignment in China, I feel that, you need to have some sort of, a similarity of opinions between the various parts of society, you know, whether it's the companies or whether it's the education sector. So I think it's not so much a grab for power. I think it is a realignment of the private sector's views to be aligned with the national development goals.
Ajay, I want to bring in, and this is the last question for this segment. I know we'll talk more about your thoughts on central banks and monetary policy in a couple of minutes, but you're tying, and your research has shown that growth stocks and their fortunes have been tied to central bank balance sheets. I think the positive correlation's at 0.93. That's almost a perfect correlation to be in tech if balance sheets continue to go up. So if it's not China and it's not the U.S., where do people look? Because that's usually, those two places is where really you get the most bang for your buck.
Oh, I think you actually do need to look at the U.S., absolutely. I think it's the fount of a lot of innovation in these sectors. So I didn't say don't look at the U.S., but here back in Asia Pac, you can look at Japan. I think they have a great semiconductor sector. You can look at Australia. There's some innovative companies there. You can look at India in the software sector, some new listings out there. And of course, the old reliables, Korea and Taiwan, for their supply chain. And now even in ASEAN, you're getting some new listings, and the market cap is going to expand. So I think and by the way, these countries, they have because they're further behind China in terms of just the adoption rates and how much runway they have, I think the potential growth in these other countries might just be faster, and they have a benign regulatory environment.
Yeah, I'm going to take the EM part of your mandate, Ajay, and ask you about the Delta variant. Should I be concerned?
Yeah, absolutely. As your previous coverage was showing, sadly in emerging markets, the vaccination rates are very low. The supplies just aren't there, and these countries are way behind the curve. But I'm optimistic that probably by the end of this year, by early next year, these rates will obviously be much higher and there'll be more supply. However, from a market's perspective, if you look at what happened in India a few months ago, obviously it was exceptionally tragic, the number of cases and deaths. However, the market didn't really flinch for too long and is up about 12 to 13% year to date. And something similar is happening in Indonesia right now, where the case numbers, the death numbers, sadly, are going up. But yet the markets, both the bond and the equity markets and the currency, are reasonably resilient. So I think they are looking ahead, they're looking through this, and they're, like me, expecting a reopening perhaps by the end of the year or early next year. And so, as we all know, markets tend to look ahead.
Okay, and Ajay, when we look at what's happening, it seems that this part of the world has fallen behind. When we look at what Christine Lagarde said yesterday, and we see the mood music in developed nations changing now and becoming more hawkish. What's your thinking on this? What's the base case?
Well, I think you've hit the nail on the head that equity markets are highly, highly correlated to the size of the global central bank balance sheets. And so while I keep hearing that the developed country central banks are getting more hawkish, or some people have that opinion, I just don't believe that. In fact, I think what she said was that, look, we're not going to be tightening prematurely, because the ECB did do that in 2011, with horrible consequences. I'm sure they've learned, and Chair Powell also talks about the same thing. So our economists believe.
I just should correct myself. She was a bit dovish, wasn't she?
Yeah, exactly. Yes. Yeah. So we think, our economists think, that the central bank balance sheets for the G4, which is China included, will probably rise by about almost $1.7 trillion from 30 trillion today to about 31.7 by the end of the year. And I'll take that, because 1.7 trillion is not pocket change, and it'll keep interest rates subdued and asset prices high. So I think the most important thing to look at is the global central bank balance sheets, and they are expanding. And even if they expand at a slower pace next year, that's still okay.